All right, everybody, let's talk about taxes in retirement. And I'm going to run through these quickly because there's a lot of them and I could spend hours on this topic. So I'll break them down in other videos. But here's the thing. There are top 10 strategies out there to minimize taxes in retirement. So I kind of went through all of our client situations and started marking down all the different types of strategies. And I really boiled it down to 10 of them. Okay. Now, some of these are obscure and some 1 out of 100 people are going to use them, but there are 10 things you should be looking at regularly. So let's run through these. First one is qualified longevity annuity contract. For a lot of people, I don't like these at all. You can only do 200,000. So if you got millions in IRA and you're disgruntled about having to take a required minimum distribution, this isn't going to make that much of a dent, but there are a lot of people that this does help. So it's a special type of deferred income annuity that the fearless leaders, the government put together, said basically you can pluck out 200,000 of your IRA money, stick it in this, and at 85, it'll trigger a guaranteed income and it'll return whatever premium you didn't utilize to your heirs. So look, the bad side, it doesn't really grow much for your heirs if you don't need it. If you're at 85 and you get a big chunk of extra income coming in, that might be a good thing, help pay for long-term care or whatever else. So I kind of like the idea of looking at this as a long-term care, funding source. But not a bad option for a lot of people. Qualified longevity annuity contract, QLACs, they call them. The other one, borrowing from permanent life insurance. Look, this is a young person's game. You got to start the permanent life insurance, which means whole life or universal life. You got to start it in the younger years. You have to consistently overfund it. Then you find yourself in retirement with a big cash value. And then you start borrowing from it. And the magic of this is if you do it properly, you're borrowing this money and it's paid back by the tax-free death benefits. So you're essentially getting tax-free income if it's done properly. So we do have to be careful about this because if you borrow too much and the policy lapses, sometimes this is a big tax time bomb. So be very careful about this stuff. The next one, strategic charitable donations. The biggest one, the easiest, most black and white, clear example is qualified charitable distributions. At 70 and a half, you're allowed to start reaching into your IRA and sending money directly to charities. Okay, so in my example here, your IRA, 10,000 comes out. You don't have to itemize to deduct the $10,000 donation because it doesn't even show up on your income. Okay, but it still qualifies as a required minimum distribution. So if you had to pull out 10,000 because the government told you had to pull it out, and you sent it directly to the charity, that qualifies as your required minimum distribution, and it shows up as zero income on your tax return. So you get that standard deduction and you didn't have to pay taxes on that 10,000 you pulled out. That is by far the most effective way to give to charities. Number 7, notice I'm going back. These are more common the further we get down here. Utilizing tax-advantaged healthcare accounts. This is becoming more and more popular. HSA accounts. HSA accounts. If you have access to one, if you're eligible to deposit into one, deposit as much as you can. And think about it as a savings avenue for retirement. Don't think of it as, I need glasses and I'm going to do it now. No, you're going to want this later in retirement because trust me, things like dental expenses and vision expenses, stuff that Medicare doesn't cover, yeah, you're going to want it for that. Oh, and by the way, you could even buy aspirin with it. So it's very liberal on your ability to use that money. Trust me, in retirement, you'll find ways to use it. You could even pay your Medicare supplement with it. Tax-free, it goes in tax-free, it grows tax-free, and if you pull it out for qualified medical expenses, it stays tax-free. That's a wonderful way to do any medical expenses. Strategically gifting highly appreciated investments. I used example of Apple stock here. 2010, 1,000 shares at $9.75 a share. That was the price at the end of 2010. It's 9,750. That today, if you held on to those shares the whole time, would be worth $168,000. If you sold it, you'd have to pay taxes on all of it except $9,000. Holy cow. Well, first of all, if you're charitable, instead of giving them cash, why not just give them shares of Apple? Trust me, they'll take them, and then there's no tax. Okay? You don't really need to give to charities just for the tax advantage, but if you're already giving to charities, think about giving the stock instead. The other one is gifting to family or children or anybody for that matter. Okay? You're allowed to give up to $17,000 a year this year. Is it 18? 17. I think it's 17. Might be 18 this year. They keep moving it on me. So you can give that amount of money in shares to a child or an aunt or an uncle or a cousin that maybe they're in a lower taxation. You can ask them to sell it and gift it right back to you. Hey, what an idea. And if you know about the tax brackets and how the qualified dividends work and how the long-term capital gains work, there are definitely ways to take advantage of this, especially in bigger families. Next one, deferring taxes with annuities. Now, this one I usually talk people out of, or I say, shame on you, you shouldn't have done that. Look, I don't have a problem with annuities. I have plenty of videos on annuities as long as they're used properly. And tax deferral is rarely needed. And nobody wants to pay more taxes this year. They always want to pay less taxes this year. But to what cost? That's what you have to remember. Tax deferral is not tax-free. Somebody has to pay taxes on this. So you don't have to pay taxes on it this year, but when are you? Okay, so if you're in higher taxation right now and you think you'll be in lower taxation in the future, great, no problem. Growth in annuities is only taxed upon withdrawal. So you can withdraw later at lower taxes or pass it to heirs and let them pay the taxes. But they have a neat little trick out there. You can separate out the growth that's in there and annuitize that so it spreads out. Stretches, the stretch is what they call it, out the taxation for the heirs. So the heirs, think about that, you got a big pool of money and it gets split amongst 5 children. That's 5 little chunks. Then you can peel off the profit on each of those chunks and make that a payment to them over the rest of their life or 10 years or whatever you want to do. Strategic withdrawal to remain in lower tax brackets. Look, this works if you are diligent and you have 3 kinds of money. So that's the one thing you have to learn about heading into retirement. Having all 3 kinds of money is always helpful. IRA money, it's always taxed when it comes out. Roth money, it's all tax-free when it comes out. Non-qualified after-tax money, that's where the qualified dividends and long-term capital gains are, okay? So we have tax-advantaged ways to pull money out here in the non-qualified, and certainly principal, which would be tax-free. Roth is all tax-free and IRA is all taxable. So if you set yourself up properly and you're organized properly, you can look at it like this. Your checking account has your Social Security and pension, that regular paycheck coming in, you're paying the bills. You have a savings account that has the cushion that is for the fun stuff, for the emergencies. And then once a year, you're refilling it. So this is how you can control the amount of taxable income you have in the year. You spend the money that's already been taxed in this savings account throughout the year, and then once a year, you strategically fill it up. So if you're a married couple and 100, just for round numbers, 120,000 is the top of the 12% tax bracket. If we know we have, say, $80,000 worth of Social Security and pension income, and maybe $40,000 in here, that's 120,000 right there. We get through the year, there's only 30,000 left. I'm going to pull from the IRA, or there's only 20,000 or 10,000 left, and we got to pull 30 because I know that that's going to push us right up to the top of the 12% tax bracket. But maybe you need to pull more money because you're getting ready for buying a car or something like that. Then once you hit the top of that 12% tax bracket, pull Roth money, pull non-qualified money. Manage the tax brackets properly, and you'll see those tax brackets coming up here. So you know the dollar amounts you're working with. And there is the qualified dividend and long-term capital gain tax brackets. Hey, look at these. These are much lower taxation. So knowing qualified dividends and long-term capital gains, if you have after-tax money in your portfolio, meaning not IRA, not Roth money, managing this part of your money properly, keeping it out of the interest-bearing investments, moving the stock investments in here, the US stock investments in here, that is how you're going to take advantage of these much lower tax brackets. That's right, zero taxation for individuals making a total income of less than 47. Again, plus the standard deduction pushes that up quite a bit. Same for this joint married couple tax return. So the standard deduction pushes this up to 120-ish, and the single brings it up to 60-ish. Okay, so you got that standard deduction. That's a zero tax bracket too. That's on top of the 47, on top of the 94. Zero taxation. We got to manage this money properly. The money invested in your IRA should be invested differently in your Roth, and absolutely unequivocally should be following a completely separate set of rules in that after-tax portfolio. That's how you're going to qualify, or how you're going to manage these tax brackets more efficiently. Then, drum roll number 2, managing year-end gains and losses. My quick and easy, a lot of people call this tax loss harvesting, and there's lots of fancy stuff out there. Really, if you've got a bunch of after-tax, again, non-IRA, non-Roth money, you do need to look at that portfolio every year. Find some positions that lost, find some positions that gained, and hit the sell button, right? So in this example, position A has a $13,000 loss, position B has a $10,000 gain. Sell both, we have a net loss of $3,000, and that $3,000 can be used against ordinary income. Okay, you're maxed out at $3,000, but $3,000 reduces the ordinary income that you had. That's a good thing. That helps out your tax return, and you're being proactive with these gains. You got 10,000 worth of gains sold and locked in, zero taxes. That's important. Okay. Now you got to be careful about the rules of reinvesting. There's a bunch of things like that, but this is a great way to be managing your portfolio every year. And then there's those tax brackets. I baked in this standard deduction right here. Again, single people's standard deduction, 14,000, married couples, 29. All right, so here's the thing. Number 1, be proactive with your IRA money. That IRA money will be taxed, period. So figure out the path to get taxed the least amount. You gotta open your eyes to the bigger picture. You cannot be looking at your microcosm of this year. It is always the bigger picture. So I want you to think about it like this. Those of you that are single and have $61,000 or less of income, Roth, Roth, Roth. Either deposit into Roth, saving that way, or be converting IRA money to Roth. Married couples, it's $123,000. Okay, Roth, Roth, Roth. Choose to pay taxes. If your total income was $50,000, that's $11,000 you can take out of an IRA, put into a Roth, and pay the taxes and only pay 12%. Married couples, if you have $100,000 worth of income this year, if you have $80,000 worth of income this year, take that extra money out of that IRA, choose to pay 12%. 2026, this is going to 15, and 22 is going to 25. This is the gray area. If your income is always going to be in this higher area, yes, you might want to consider choosing to pay the taxes, because 2026, 22 goes to 25, 24 goes to 28. Okay, so please pay attention to this. Make sure that we go and make the proper choices. And those of you in the 30+% tax brackets, defer. There's no way you should be using Roth. You should not be contributing to Roth. You should not be contributing to Roth. You're choosing to pay 30-something% when later in life, you're probably going to be in the 12, 22, 24 type tax brackets. Okay? Defer, 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 or your heirs are going to be in lower tax brackets. One of the two, unless you're Warren Buffett. And if Warren Buffett's watching this, hi. All right, everybody, that is your 10 quick versions of all the little tax things you should be paying attention to in retirement. I hope that helps. I love this stuff. Retirement planning is a puzzle, and tax planning is certainly a part of it. You should be as efficient as you can be, keeping as much in your pocket as possible. If you want to meet with me for any reason, again, 30-minute free meet and greet or hourly advice or whatever you're looking for, I'm always happy to help out. Yourinvestmentcounselor.com. I am real, and you will get an appointment with me, believe it or not. We also have a nonprofit organization that we do a lot of education through. So the full form education, hour-plus long classes, fpfeaz.org. We do them over Zoom. You can find the full schedule on there. And we also have the recording of the class of the month on there. Give us a call if we can help out in any way. I appreciate everybody viewing these. Thank you again. Always happy to help. See you next week.